All right, well, good morning, traders, and welcome to our Trading Week Ahead broadcast. I'm Ken Calhoun, your host, coming at you live here from Colorado. As always, all information is for educational use only, not making advice about what to buy, sell, or hold. This is all for impersonal public learning of some of the different trading patterns. You may have seen me at Traders Expos or all over the place. So just a reminder, if you're not yet a member of my live room, we meet 5 days a week, usually from 8:30 to 10:30. I'm always there at least 9 to 10:30. I'm usually there early. So if you do want to work with me 5 days a week, try out my live room at tradingtheopen.com. Anyway, let's go ahead and get started and take a look at markets first. No more PowerPoints. Okay. I don't love PowerPoint. I love trades. I love charts. The S&P's been in an inexplicable bounce here lately, mostly driven by artificial Fed meddling with the markets and fluffing the markets up. The main technical signal is we've got a mean reversion pivot. This 2800 is exactly, which is why we see kind of a spinning top there / doji type pattern. The market came down, it bounced to around half. That's a key inflection point. It may go up a little bit further, but this pattern is usually one in which you get additional selling. You have a move down, you get a 50% retracement to the upside, and then you get another wave of selling. So that's our S&P. You can see similarly, again, the 50 SMAs right near the 2900. We've got previous support here at the 2650. That's kind of a key line in the sand, is that 2650, because that's the previous high. If you take a look at our VIX, it gives us an exact opposite picture, right? The VIX has gone up during the market crash, and then it's pulled back down again to the mean reversion pivot. And what you want to look for is 2 green candles in a row and a breakout that holds above that for recovery, or for a sell down, 2 reds in a row like we had recently Wednesday and Thursday, and then a drop under this 40 SMA. But again, from a volatility standpoint, the market has been declining in volatility. And that's why we've seen, if you're curious as to why the gaps have gone nowhere, which is frustrating as a day trader frequently, you get a gap and then sideways stock market like we saw yesterday in the S&P. We had a small gap up and it just kind of shook around sideways. That's because the VIX, or the internal volatility of the markets, is smaller or lower than it was a few weeks ago. So I do anticipate that volatility to return. How can it not? With our current world pandemic, record unemployment, earnings are going to miss left and right, small business bankruptcies, the sky is falling. But despite that, we persevere as traders. We're trying to figure out how to make money in the markets. What I'm doing is taking small shots in the inverses because they're starting to get down at attractive support levels, right? If you're looking at things, like the SQs, it's down here. I traded it on the way up, tried to catch a couple of dead cap ounces here on the way down, taking stops a little bit on the way down, but not much. I made more money on the way up than I lost on the way down trying to catch these guys. I'm going to play this long up at any new 2-day high, and especially multi-day highs, or say 17. If we recover this support level, may be good for a bounce. Same thing with instruments like VXX. It's done a nice pullback off its bullish, bearish engulfing and a bullish run up. One pattern that I want you to start looking for is one that I've taught at my money show appearances for decades, which is an acceleration ramp. You got a steady uptrend that's a precursor to a breakout that then runs, right? So the pattern is to look for it's kind of a steady uptrend that then starts to do a kind of slope of a line here, like 20-30 degrees of arc, that then goes to a 45-degree angle, and that's the best one, and boom, it runs up. Now, one thing I want you to be really careful about in our current markets, at least what I'm doing in my own trades, is have shorter, smaller time frame duration trades. So for swing trades, that's usually anywhere from most of my swing trades this past couple of weeks have been no longer than 2 or 3 days in duration, whether it's my successful bottom fishing and things like casino, oil, and gold stocks and ETFs, which I made money with, or unsuccessful trades in the inverse is trying to catch a bottom that take small stops. So as you're looking for plays, make sure number one, there's 3 rules of volatile market trading. Number one is play the outlier strongest charts with the biggest trading ranges, as usual. I like trading things like our leveraged ETFs and oversold commodities like oil and gold that are starting to bounce, and casino stocks. I was trading MGM and PENN successfully, so those made nice bounces lately. So rule number one is look for the outlier sectors or industry groups or ETFs, whatever that you're trading that has the biggest trading ranges, therefore the biggest profit and risk potential, right? Things that have big ranges make sense. Number 2 rule, so outliers only, the strongest to the best of the brightest. Rule number 2 is to make sure that you're looking for position sizing. Your position sizing or scaling strategy needs to adapt to the volatility of the markets and how long the trade works out before it stalls and doesn't, which often cases is just 3 or 4 days for a swing trade. And one thing that I'm finding is a smart strategy for our current markets is intraday swing trades. And that's where you put on the trade early in the morning, put a stop loss under the low, and then come back and tighten up a stop, a trailing stop either midday if you get a midday reversal start to form, or towards the end of the day and close out the trade near 3:30, 4 o'clock. So intraday swing trading is another strategy that's especially useful in a volatile market. Because what happens, oftentimes you'll see something runs up all day long, and then the next day it gaps down and takes back at least half of the profit. So it's a good idea. If you have a chart that's ending at a 2-day high, you may want to leave some of it on the table for an overnight hold, but do take profit. I take profit usually. I play it actually more aggressively taking profit. So if I'm in, say, 100 shares and it's gone up a couple of points that day, I'll usually sell 70 or 80 shares into the close to book the profit, sweep the profit out of the trade, let the other remaining 20, 30% of the trade ride for an overnight hold. And if it gaps up, great, that's icing on the cake. If it gaps down, dodged a bullet and took my profit in the previous session. So I want you to give a lot of thought to risk management and how to manage your trades appropriately. From a sector standpoint, our pharmaceuticals and biotechs have been really strong lately. It's helpful to visually kind of pull up your sector charts, like that's the DRG. Here's the semiconductor, the SOX. That's not nearly as good, right? Lots of red candles, lots of chops. I'm not looking to buy AMD or Micron. But that chart has a sharper angle and it's mostly green. So that's another tip for volatile markets is trading volatility. Make sure that you compare your sector charts, because what you really want to get a clear understanding of is where's the money coming inflow, where's the capital inflows coming in from. It goes from one sector to other. Out of capital goes, it's like water. It'll go out of one sector and the money finds a home, they put it into another sector. So it may go out of semis and into biotechs, or out of gold and into oil, or whatever it is. Keep an eye on the sector charts to see what they're telling you. What else do we have? So there's the biotech sector. Now, one that I've traded is Nugget, and we're going to cover that in my swing scans in more detail. But these kind of charts where you've got a moving average crossover to the upside, an uptrend off the bottom, a nice green day here, and we're trying to take out a previous high, all lines up for a potential good trade setup in here. Those are the type of charts that I cover in the live room and in swing scans for all my regular subscribers. But you always want to have a game plan of, where's the biggest profit opportunity out there at the cost of lowest risk? And always evaluate risk reward. So the price that proves this trade wrong would be a loss of this support line, right? So this is your risk, and exit target would be right under 20 up here. That would be reward. So the risk reward numbers add up. When you're looking for bottom fishing or pivots in our current market, look for something that's swooped down from a big drop like oil, or like Apache is another good example. We'll pull out that one in a second too. I was trading that one too. successfully. Thanks to a trader who mentioned it in the afternoon last week. Look for charts with good risk reward, where the downside risk is small and it's had a continuous uptrend for at least a week or so, at least a minimum 2 or 3 days, so preferably a week or more. And so you can see if you connect the dots on the bottom here, you got a MACD crossover here flashing a buy signal. We've got an uptrending lower lows here. We've got a very small risk window, relatively small, just a couple of points here, and a large reward window. That concept of risk reward windows is one thing I also teach in the live room at tradingtheopen.com. So hopefully you guys want to join. What I'm always looking for is, where's the next trade? Where's the next setup? If you look at one of our oil stocks, Apache, this one too. See how the risk is relatively small, but the reward, at least to this MA line, is much bigger. So again, as like trading 101, you want a minimum 2-to-1 risk reward. I like to go for 3 or 4-to-1 so that the downside risk is outweighed by the upside potential by a multiple of at least 2 or 3, 4 times. So if that makes sense, kind of like the bottom fishing clinic, at least a few initial thoughts is look for charts like this that have really, really big ranges. And they're not just starting to do a dead cat bounce, but they've been in a continuous uptrend for at least a few days. And then if you have other confirming technical signals like a MACD crossover bounce or large incoming volume or a cup pattern or ascending triangle or bull flag or whatever you use to make decision support work for you, start with the end in mind. The smartest charts that have the best profit potential with a minimal upfront risk. And that's what you do in this market. And then, of course, against the backdrop is you throw a lot of darts and take lots of small shots at it. Hey, Peter. Thanks, man. Hey, Mukesh. Hey, Padma. Hey, Mira. Hey, Ed. Wow, big turnout. Thanks, everybody, for being here. We're coming up on 6,000. Thanks. Hey, let me know if any questions. I'll stick around for a few minutes, but that's most of what I got. Look for bounces in oil, gold, casino stocks, and inverses. That's what I'm trading at least. So hopefully we'll all do well with that. Visually, keep an eye on the VIX and the S&P to see if this mean reversion pattern starts to form on Monday or Tuesday, right? The S&P it dropped, it bounced around half. Oftentimes it'll keep going back down. So I'd be very cautious about buying new stocks here for any bounce. Now's a good time to ring the register, at least tighten up a trailing stop on open longs. What else do we have? Mukesh, yeah, MGM. A lot of the casino, I was trading MGM starting right over 7 because it had a nice bounce pattern. But yeah, there may be room to run in a lot of the casino oil and gold stocks. The main thing is develop a process that makes sense based on volatility. And so one thing, for example, if you cycle through some of these charts, if you want to play the market directionally long, SPXL is a good instrument, right? It's got lots of volatility and range. And thanks to the trader who mentioned this one, I was trading at TQQs, but I like SPXL better, so that's a good one. If you're looking at inverse plays, we got things like, a lot of these, so many of these inverses that have run up, they ran their course, and now surprisingly, I thought they'd only do mean reversion pullbacks like VXX, but a lot of the inverse ETNs and ETFs have pulled all the way back down to support. So it's a really good buying opportunity. At least that's how I'm treating it in my own trades. I'm looking at these as buying opportunities on recoveries. Kind of head and shoulders here, right? Left shoulder, head, right shoulder. So watch out below. But when it bounces, it's got lots of upside, right? It also illustrates a concept I call buying into previous strength. If it has a recent history, when it comes to buying bounces, what usually doesn't work is something that's fallen off a cliff and it goes way down and it's just nothing but red on the screen. That's usually what you don't want to buy. But what you do want to do is, at least what I do, is I trade bounces on things that had previous history of recent strength that's been proven to get buyers in the house for at least a few weeks in a row, sometime in the last few weeks or month, and all the inverses fit that to a T. And what I'm tickled about, what I'm thrilled about, is I don't have to chase. And I was concerned this was going to be, I traded a lot of the inverses correctly on the way up, and I was afraid I'd have to pay up, pay more money and chase up at high, which I hate doing. What I prefer to do is buy these kind of pivots where you've got a recent run up, kind of like a gap. My favorite pivot pattern for day trades is something that gaps up, sells down to the previous day's high, and then bounces. That's the single best pivot play for an intraday trader. I won't say guaranteed, but in my experience, if you have a gap that fills the gap to the previous day, and again, not for these cheap under $10 crap stocks, but stuff in the $15, $20, $30, $40 share range. If it gaps up, sells down right on the open down to the previous day's high and then starts to bounce, that's the best pivot play for day trading. Similarly for swing trading, my favorite pattern for bounces in swing trades is not to speculate at stuff that's been falling off a cliff forever and then just got all of a sudden looks really cheap. That usually gets even really cheaper, so that's usually not a good play. I've learned that the hard way. What I've learned, I believe, is a more effective strategy potentially is if you have something that did a lot of buying recently, then just as much selling, and then it starts to get another wave of buying. That's a good inflection point for trigger long. So, if this guy bounces over 27 or those kind of things, for the types of signals I look for a recovery play with an exit target around the midpoint, or at least the initial exit target is a mean reversion bounce to the upside, right? Just like we see our S&P has been sold off. It bounced up to around exactly the middle, the 2800, 2850s, the exact mean reversion pivot area for the S&P. So it may keep climbing up. It'd be surprising to me if it traversed all three of these and kept skyrocketing on up and took out all-time new highs in the middle of a global pandemic. Actually, it wouldn't surprise me because the more you trade, nothing surprises me anymore, right? Even if it defies common sense. The market can stay irrational longer than we can stay solvent, right? So we just go with price action, the directional bias in the market. But when you start to see patterns like this that tell you, that's what Wall Street technicians are using, right? We're looking at these kind of patterns. Got a little hammer there. That was a little dead cat bounce. So we're getting really close to a zone within which we may see some consolidation, a pullback, or a big sharp drop. It'd be, if I were a Vegas odds maker on the charts, I'd only give it a 20% chance of going up to 3,100, 3,200. I give it more 70, 80% chance of cycling back down to the 2,500 or retesting the earlier March lows down to that 2,200 moving forward. And similarly, you keep a close eye on the VIX. Selling down here, it may keep dropping down to this window here, but it's more likely at some point to start to find a base and spike back up to 60 or so. Now, if you are, I'm gonna say, I can't give trading advice, but for myself, for my open swing trading long positions, if the VIX gets back over 50, I'll start scaling out of any remaining open long positions. And if it gets back over 60, I'll be cashing those and back into my inverses with some size. So always trying to develop a kind of a step-by-step strategy, if then conditionals. If the market does this, if the VIX does this, then I'll start putting on these kind of trades. Again, small nibble trades. I usually start off most trades with anywhere from 300 to maybe $800 or $1,000 worth of the shares. So maybe 30 shares of a $30 stock, or 40 shares of a $20 stock, or 50 shares of a $10 stock or whatever it is, around anywhere from 300 to 800 or 1,000, usually around $500. Plant all these little seeds, and the ones that start to work out, you can scale into, and the ones that don't, you take really small stop sign. Oh, thanks, Jim. Appreciate it, man. Saying this is Golden Lesson Saturday. Yeah, sorry, my energy level and my voice are both kind of on the fritz a little bit. I've been really exhausted doing, what was it, 8 webinars last week, so it's been quite the run. But anyway, that's the kind of thinking process you want to take as a trader, is trade markets first, and then individual instruments and industry groups second. So bounces in oil, gold, and casino stocks are all how I'm trading right now. And also starting to fish away at some of the inverses in case they start to bounce. There's plenty of them out there, right? Trying to find. Energy also. People aren't talking about energy, but some of the, both energy and, what was I trading? I was trading ERX. I think it was ERX. I was trading Apache. Yeah, ERX has a lot of upside, so see how the MACD crossover is a bullish crossover down there on March 24th, and this guy's been slowly grinding to the upside. What I like about it, it's got ginormous, a lot of big upside potential. And again, a lot of times some of these guys are risky because of the volatility, but I was trading OXY last week too. I made some money with that guy. Not a lot, but it did a nice bounce. Anyway, a lot of these oil and energy and gold stocks and ETFs are starting to bounce, so keep an eye on those. Play it safe, and I'll see you guys next time. Thank you for being here. Appreciate it. And apologize if my energy level, I'm not wild and excited and dynamic. It's been a long, long week, and psychologically too, with all this virus stuff I'm worried about. So anyway, you guys stay safe. Aren't we all, right? You'd be nuts not to be, right? So be safe, hunker down. At least we can trade, right? Don't have to worry about going out and getting infected by trading at home in front of our computers, right? So that's how we do it. Right, Bill, I agree. Hey, you too, Ned. Appreciate it. Yeah, Phil, it's been. Hey, thanks, Bill. Appreciate it. Hey, Ahmed. No, I'm not trading airline stocks. Airlines and cruise ships, no way. Transports, not looking too good. Any industry sector that's going out of the way to ask for bailouts is probably not a safe bet for an investment or a trade. So I'm still wildly bearish, and I think the market's overdue for a crash. The Fed's trying to fluff it up with recent multi-trillion-dollar liquidity boost. And short term, yeah, that'll goose the market a little bit, but it's all a house of cards. You have the underlying horrible earnings to deal with, right? And so in anticipation of that, it makes sense, in my humble opinion, to start accumulating shares of the inverses down here as they're retesting new lows for when the market does go back down, which it will definitely do, right? The market, I don't know how many people would sensibly expect the market to put in a bottom, the market will rally from here on out or something. That's, to quote the Princess Bride, inconceivable, right? With the global pandemic, record unemployment, all the negativity out there, it's really surprising the market has even bounced up even as much as it has, right? So I'm looking to see if we start to lose support on a multi-day low and then crash down here, do a little dead cat bounce and keep going down. So, I mean, and if the market keeps going up, that's fine. We play price action, right? SPXL is good for an upside move. SQQQ if the market moves down. I got a wrap, gang. So thanks for being here. Appreciate it. Trade smart and be safe out there.